When you take a look at how the FX markets are trading at the moment, what is it telling you about the reaction to the deal that was reached over the weekend?
Well, I think the big story of the last couple of weeks, which has actually seen the US dollar on balance a little bit weaker, has been this interplay between risk sentiment, obviously, of which the banking sector has been at the epicenter, and this precipitous fall in US interest rates. And bearing in mind that it was the relentless rise in US rates since mid-2021, almost irrespective of what was happening with interest rates elsewhere in the world, that really was the primary driver of US dollar strength. The fact that US yields have fallen as far as they have, I think explains why the US dollar has been weaker. Risk sentiment has clearly been working the other way, so obviously the acid test is going to be whether the very cautiously tentative signs of slightly improved risk sentiment that we've seen showing up in a stronger yen, we've seen showing up in a stronger Aussie. As Annabelle just mentioned, basically we have seen equity markets with a somewhat stable sort of footing at the start, and we've seen US Treasury yields so coming back 10-11 basis points in Tokyo. So maybe those forces are sort of starting to go into reverse a little bit, and obviously a lot depends on what the Fed will do this week and the messaging that sends. So I still think these sort of competing forces of US interest rates, and is the Fed going to be cutting rates at the end of this year, which is what money markets are currently priced for? Are we over the worst, or have we basically cauterized a systemic, the next sort of source of systemic pressure from the financial sector by the Credit Suisse news over the weekend? There's still more questions than answers, I think, in terms of how it plays out for currencies.
Yeah, and as you say, so much depends on what the Fed does, what the Fed messages, but also, what the markets kind of goes with in terms of Fed expectations. In terms of the impact on some of the high beta currencies like the Korean won, for example, or the risk proxies like the Aussie dollar, do you expect kind of further weakness for now?
Well, our core view is that we're still thematically US dollar bears, and on that basis, those sort of big sort of pro-cyclical currencies like Aussie and Kiwi, and up in Southeast Asia and North Asia, Korea would be the prime example. On that basis, we've still got forecasts for substantially stronger levels for Aussie and Kiwi as we go through the year. But that could change on a dime if we do see a deterioration, and particularly those financial conditions that Annabelle talks about. I'm a big fan of the Bloomberg Financial Conditions Index, but it's actually no tighter today than it was last October. So in that sense, the Fed was still signalling we've got more work to do, and if financial conditions aren't tightening excessively, I think they will push on, and that potentially might provide a little bit of support for the US dollar. And unfortunately, what financial conditions indices can't do is track bank lending standards, and if it is the case that the banks are really starting to rein in their willingness to lend, which wouldn't show up in financial indicators yet, that might be a cause of concern. And if the Fed were to pause this week, I think that would be one of the things that they would be most alive to.